Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell here, and stocks mixed. Let's take a look at the popular averages. The Dow is up about 670 points. The S&P 500, your broad gauge, is up about 0.2%. Your tech-heavy NASDAQ is down about 0.3%. We do have buyers stepping in. One big story for the markets today, you'd have to say Oracle, which is just getting whacked in today's trade. Look at that. That's on AI build-out concerns. Oracle, of course, now seen as another kind of AI bellwether. That has created some caution around other AI heavyweights today, like NVIDIA, like the Mag 7. Another big check on the AI trade comes after the bell today, though. Remember, Broadcom earnings are on deck, and we will cover them. Meanwhile, crypto regulation is taking another step forward as big bank executives meet with lawmakers. Let's get to Yahoo Finance's Jennifer Schonberger with the details. Jen.
Hey there, Josh. Chief executives from Bank of America, Wells Fargo, and Citigroup are sitting down to meet with both Republican and Democratic senators right now in the Capitol to discuss overarching crypto legislation. Bank executives expected to discuss bank permissibility, illicit payments, as well as interest paid on crypto, which Yahoo Finance is told is the greatest topic of interest for the banks. Now, a spokesperson for bank lobbying firm, the Financial Services Forum, which helped orchestrate this meeting, told Yahoo Finance in a statement that, quote, America's largest banks, the strongest, most regulated institutions in the world, play a critical role in driving digital assets innovation. The meeting is another opportunity to share their perspectives and serve as a constructive partner in crafting smart policy to ensure that the U.S. remains a digital assets leader. Now, JP Morgan CEO Jamie Dimon was not in attendance today because of a scheduling conflict, Yahoo Finance is told. Banks are trying to push for what they want as part of this large overarching crypto legislation as senators really work to put this bill together. It is proving to be a heavier lift here in the Senate. Earlier this year, Congress passed a bill to regulate stable coins. However, this one covers a much larger swath of the crypto universe. And earlier today, a group of Democratic senators, I should say, were meeting with Republicans led by Senate Banking Committee Chair Tim Scott in his office to try to get closer on this legislation and breach some of those sticking points. Take a listen to what Democratic Senator Kirsten Gillibrand told me.
Good to see. What are your expectations for this crypto bill? Continued bipartisan negotiations. Do you think we could get something done by next week?
I think it needs more time, but I'm going to work as hard as I can.
And you heard Gillibrand saying we're probably going to need more time. In talking with some other senators from both sides of the aisle as they were leaving that meeting this morning, both Senator Kennedy on the Republican side and Senator Schiff on the Democratic side, both were pretty mum on whether they thought things could move forward. When I asked Senator Kennedy whether we could see a markup and a vote on this legislation out of the Senate Banking Committee by next Thursday, he said, I don't know. So it sounds like banks really trying to get in on the sausage-making process here, which may spill into the new year. Josh?
All right, Jen, thank you. Turning back to the markets, a banner day for the Dow as investors look beyond big tech and the AI trade, and the moves coming after the Fed cut rates for the third meeting in a row on Wednesday. Join me now. We got Russell Price, Ameriprise Financial Chief Economist, and we got David Waddell and Associates CEO and Chief Investment Strategist. Guys, welcome to you both. Russ, I will start with you as the resident economist on the panel. Why don't we start with the Fed, Russ? Did you hear anything, Russ? Did you see anything that surprised you?
Well, I think officials went into that meeting with trouble on both sides of the mandate. You have inflation rising, you have the job market coming to a stall. So it's really all about their projections, what the path ahead is likely to be. Because we were in the consensus expecting a quarter point cut yesterday. We were a little bit surprised at the tone, a little bit more hawkish than we expected. But we don't think that there will be another cut in January because inflation will probably be still rising. The job market looks like it may be stabilizing, but that's a big question mark still. I think next year we'll probably get 2 or 3 cuts, and that seems to be what the dot plot indicated. So I don't think there's a whole lot of surprise, but certainly the underlying data is still pretty much questioned.
You heard Jay Powell kind of outline, Russ, what he forecasts for GDP next year. What do you forecast? What do you think?
Next year, we have a target of 2.5%. That's based off of looking at 2025. We're probably on pace to generate 2.3%. At the beginning of the year, next year, we should see a boost, particularly for that lower income segment of the economy that has been struggling. They should get a boost from some of the provisions of the One Big Beautiful Bill Act, the no tax on tips, no tax on overtime. Many seniors will get a $6,000 tax deduction. So that lower income segment of the market should get a little bit more spending power and give the economy some more momentum heading into the year.
David, I want to bring you in here as well. You've been listening patiently. What do you make, David, your outlook for the economy next year? Does it generally sort of dovetail with what Russ is saying there?
Yeah, pretty much. I mean, if you looked at the summary of economic projections, I think the big surprise was how high they marked up their GDP estimate without marking up their inflation estimate, without marking up, or marking down their unemployment estimate much. And so they see steady state really for unemployment. They see steady state for inflation, and yet they marked up GDP a good bit. I mean, that's a great reason to rally, as is the fact that they've put another $40 billion of liquidity in the market. And I actually thought he was kind of a chicken hawk in his statement. I didn't see it as very hawkish at all. And it doesn't really matter because Trump's just going to replace him with a dove. So we're going to get a lot of monetary stimulus. We're going to get a lot of fiscal stimulus. The risk is that it does cause inflation. And if it does, then at these valuations where we're kind of at parity between the 10-year and the S&P 500 multiple, it could create some headwinds for us. But if things just kind of stay steady state, which is what the Fed says, and we get more economic growth, that means more revenue, that means more margin, that means more earnings, then the market is right to go higher today and probably righter still to go higher into next year.
Russ, one topic that came up yesterday at the presser was AI. And I'm curious, when you think about that great trend and theme, just through your kaleidoscope as an economist, how do you think, Russ, about its impact on GDP and the labor market?
Yeah. So the labor market has stalled. And so the question becomes, is AI part of that stall? Is it that companies are now getting a lot more productivity out of the workers that they have? They don't need to make any more new hiring? Or is it because of maybe they're dealing with the tariffs, or maybe they're just seeing a decline in overall demand? I think the overall picture paints a situation where it's largely small businesses that have cut jobs or stopped hiring. And that indicates to me that it's more on the tariff side of the equation. Job losses from artificial intelligence will come, but I don't think we're quite there yet to where they're going to be the driving force behind the labor market just yet. I think it's going to be a much more longer stretched out period of time. And in reference to the Fed's dot plot, I do think that it's going to be a pretty strong productivity producer. And that should allow the economy to grow at a better pace than its normal sustainable rate, even with keeping unemployment low and keeping inflation in check.
David, let's stick with the AI theme, because you say here we are absolutely in an AI bubble. Let's stop there, David. I guess two questions. What do you mean by bubble, David? Define that for us. And what are the metrics, David? What are the indicators that tell you, yes, we are in one?
Oracle, right? So you get overexcited, you get overlevered, you build excess capacity, and then there's a duration mismatch with how quick all that revenue shows up, right? If we've got to build $3 to $4 trillion worth of stuff between now and 2030, then to monetize that at a 10% ROI, we've got to do an extra $1 trillion in revenue a year across the hyperscalers, and it's just not going to happen. And so here's an interesting stat for you on the Mag 7 this year. Only 2 of the Mag 7 are outperforming the 493 index. And the Russell 2000 is outperforming all but 2 within the Mag 7 too. So I think there's already been capital leaking out of the AI trade. And if you look at CDS spreads and things with Oracle, they've got negative cash flow. They're going to spend 75% of their revenue building out data centers for OpenAI. I mean, they may have an Icarus complex over at OpenAI. I don't really know. So I just think there are other places to go. And as the dot plot dictates, if we're going to get 2.5% in GDP growth next year, you don't have to go chase AI. You need to be in financials, you need to be in materials, you need to be in industrials. Within the S&P 500, that's not a big weighting, but within the 600 and 400 S&P indices, those are very large weightings, 2x weightings, and that's why those indices are rallying. There's just no reason to go chase these over-leveraged names. I hope that they do build out a whole bunch more CapEx and it's up 25% or 30%, as they're saying next year, because that means you're going to sell more cement, you're going to sell more steel, you're going to sell more copper. There's just a whole lot of ways to benefit from this as it migrates beyond the initial hyperscalers. And you're already seeing that in the indices this year. And then one last stat, and I'll stop. There's $60 billion or $1 trillion in the S&P 500. There's about $5 trillion in the S&P 400 and the S&P 600. All you have to do is have a little bit of rotation and you get the kind of spreads you're seeing today.
David, Russell, great discussion, guys. Thanks so much for your time. Appreciate it.
Thank you.
Coming up, the White House's take on the Fed's move and what's next for the economy. Joe Lavorgna, who serves as counselor to Treasury Secretary Scott Bessent, joins us. That's coming up next. Bitcoin slipping after the Federal Reserve rate cut did not switch the risk-off mood for investors. Yahoo Finance's Inez Ferre joins us now with the latest. Inez.
Yeah, Josh, if we take a look at Bitcoin, it's trading at around 91,000 per token. It's down about 2.5% over the last 24 hours. There's definitely a decoupling trend that we've noticed this past month, with crypto decoupling from the broader market. If you take a look at the S&P 500, I mean, it's on pace for a record close today. Meanwhile, you've got Bitcoin that year to date is down 3%. This would be the first time that crypto meaningfully decouples from the broader market, equity market, for the first time since 2014, if we keep on with this pace. Because you've had Bitcoin that's not been able to meaningfully punch up above 94,000. That's a level that some analysts have been talking about. And also the fact that you've had recent buyers that have a cost basis of about 103,000 on the token. So anytime you see a rally, you would have traders that are selling into that rally rather than accumulating more. But what is the catalyst that is going to take crypto higher? Well, look, we know that the Fed cut from yesterday, that was already baked in. Now there may be a pause in January. So the question really is, what will it take for crypto to go higher going forward? I mean, ETH also, look, down more than 5%, really giving up some of these gains that we've seen over the last several sessions for Ether. If we take a look at crypto-related stocks as well, not a great day for those. You're looking at a coin that's down more than 2%. Robinhood down 9%. And this is because Robinhood's trading volumes in November were down across the board for equities, options, and crypto. So you're seeing that the stock is slumping. But if we take a look at a year-to-date chart for Robinhood, it's still up 230%. This is the fourth best performer of the S&P 500, Josh.
All right, Inez, thank you. Appreciate it. President Trump's immediate reaction to the Fed rate cut Wednesday was that it should have been bigger. Let's get back to Jennifer Schonberger on Capitol Hill with more insight on the White House's view of the economy. Jen.
Thank you, Josh. And for more on that, I want to welcome into the program Joe Lavorgna, counselor to Treasury Secretary Bessent. Joe, thanks so much for joining me. Always great to see you.
Thank you. Thank you.
The Fed yesterday increased their outlook for the economy next year. They now see GDP growth of 2.3%. Fed Chair Powell said that he thinks that any price increases from tariffs could peak in the first quarter. They see inflation falling to 2.5% next year, but the unemployment rate is expected to hold at 4.4%. What's your reaction to that forecast for next year?
We're growing, Jennifer, at 3%. According to the widely followed Atlanta Fed, we were 3.6 last quarter. That follows growth of 3.8% in the second quarter. And when you take the federal side out, because the Secretary Bessent and President Trump want to get rid of wasteful government spending. We find the economy is doing even better. It grew about 4.5% in the second quarter. So we're generating very strong growth. And with the productivity trend we've seen and with tax policies, Trumponomics, if you will, means we should be getting much faster growth. 2.3 is not, I'm happy that I applaud the Fed's for revising up their forecast, but those numbers are way too low. I mean, in President Trump's first term, growth was just under 3%. And before the pandemic, it was actually almost 3.5% right before the pandemic. Productivity is much stronger now. The president's policies, they're reinforced from the first go, and they added some extra real important factors like the expensing of factories, overlay that with abundant energy costs, which are pushing prices down to near 5-year lows. And the Trumpian economy should do much better, has been doing much better than 2.3%. Inflation will move lower, Jennifer, and then the unemployment rate will certainly drop. So there's a lot of good things happening, and I feel like there's the optimism is for real, and some of the economists, they are known as a dismal science, and maybe they're proving that a bit.
Well, Joe, just to build on that, I mean, you painted a very robust picture for 2026, and Treasury Secretary Bessent has said that we could see tax refunds of $1,000 to $2,000 per household next year because of the tax bill. That seems to me to stimulate quite a bit of demand, and the Fed has only penciled in one rate cut for next year. Does that seem right to you, where at the same time the president believes that rates should be a lot lower than where they are now, and he believes that the Fed should have cut by much more than they did yesterday?
Well, I mean, President Trump has got a very good instinctive knowledge of how the economy works. And we saw in the first administration when the president was arguing for lower rates that he was correct. We had productivity that was very strong in the first Trump term and very low and stable prices. We're getting even faster productivity now. Inflation rates are going to be trending significantly lower. So I totally understand the president's concerns and frustrations. In financial markets, when you look at things like the slope of the yield curve, what you see is that policy does appear to be restrictive. In other words, not even neutral, but it's actually holding the economy's potential ability back. And the president understands that. He operates in the real world, not the ivory tower world of academia, where many of the economists that work at the Fed perhaps occupy their time. And you could make a very compelling case for rates going down significantly further.
To your point, Joe, the Fed has cut 3 times since September, and you look at the yield on the 10-year Treasury, and it's sitting around 4.1%. Obviously, there's other forces in the markets that perhaps are counteracting what the Fed is doing, but are there any steps the Treasury plans to do to try to bring the yield on the 10-year Treasury down? Because as we know, that affects so many borrowing rates in this economy, particularly mortgage rates.
Well, let me say this, Jennifer, 2 things. Number one, you know, the difference between the Fed funds rate and the 10-year Treasury rate is still very narrow. And that's because the funds rate is high, even by Jay Powell's own admission. Rates aren't even at neutral. What the Treasury can do and what Secretary Bessent has done is put in place policies that will help with the president's vision and leadership of restoring fiscal sanity. I mean, no longer are we going to be running 6.5% budget deficits as a share of GDP in a full employment type economy, which was lunacy. And we're seeing right now significant improvement made in the back half of fiscal year 2025. And the good news is so far in fiscal year 26, which started in October, you've got double-digit gains in revenues year on year, and you've actually got continued declines in outlays. That is a recipe for economic health. And by the way, Jennifer, as you probably know, the U.S. bond market, as Secretary Bessent is rightfully proud of saying, has been the best performing market in the industrialized world. Rates have come down significantly from where they were, And as the administration continues to get the U.S. fiscal house in order, you're going to see those interest rates move lower. And once those interest rates move lower on less inflation, those mortgage rates are going to come down, and we're going to reverse everything that happened under the prior administration when inflation was running rampant and people couldn't buy things because rates were too high.
Switching gears, Joe, Treasury Secretary Bessent has put forth a new letter to make changes to the Financial Stability Oversight Council, a creature left over from the financial crisis. And part of the changes that he is proposing include unwinding some undue burdens, regulations on some of the banking system. What impact do you think that these changes are going to have on financial stability, the financial system, and our economy?
You mentioned creature, Jennifer, which I'm assuming was a pejorative term. The secretary, obviously spending a legendary career in the private sector, knowing how markets work, wants credit to flow freely, wants prudent, sound regulation, which is instrumental in maintaining the faith and confidence in the U.S. financial system, its depth of capital markets, which is unprecedented. But we want to make sure credit goes to the economy, that small businesses gain access to that credit. They're the backbone of growth. And therefore, the secretary is making these changes. They're prudent to get credit flowing more freely and make sure we're not doing things that don't make any sense and hold the economy back from its full potential. We want to get this economy continuing to improve for all everyday Americans and getting those wage rates up, getting growth accelerating, getting that capital spending that the president has helped push into the system, getting that to become as diffuse as possible. And you need the lending mechanism to help us on that score.
Well, we'll have to leave the conversation. There are so many more questions for you, Joe, but hope to have you back soon. Thanks so much for your insight.
Thank you, Jennifer. My pleasure.
That's Joe Lavorgna, counselor to Treasury Secretary Scott Bessent. Josh, I'll send it back to you in New York.
Great interview, as always. Thank you, Jen. Coming up, we got to look at some of the top trending tickers on Yahoo Finance, including Robinhood and Rivian. We'll tell you why. Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma. Join me now for a look at Roku, Robinhood, and Rivian. I'm going to start off here with Roku. That stock an upgrade over at Jefferies to a buy, Brooke. They see upside to consensus estimates on platform revenues next year. Wedbush, I saw, also boosted his target on that stock, citing growth opportunities.
Yeah, and what we're seeing this morning was a bit of a pop and now a bit of a pullback. The stock up about 0.6% as we make our way into the close this afternoon. But keep in mind, year to date, the stock has been seeing quite the run. It's up more than 40% compared to the S&P 500, which is trading around 16 to 17% gain year to date. And so definitely ahead of that benchmark index. And what has the street excited about a few opportunities in the pipeline for Roku? Wedbush saying in that note that they expect Roku to continue to gain market share as ad dollars migrate from linear to connected TV. Also keep in mind 2026 is a midterm election year, and so definitely more opportunities for ads there. Also, Jefferies upgrading its price target as well to $135 from $100. That company also citing advertising, ramp up spending, and subscriptions expansion also being opportunities for Roku to really gain momentum. And keep in mind, the company is also working with companies like Walmart and Amazon to really increase its direct e-commerce opportunity. And you also might have seen those QR codes. And so that's certainly benefiting the business too.
All right, now looking at Robinhood as well, those shares under pressure. The company reporting a decline in trading volumes for November. So this one, okay, so they report that its November trading volumes did see a month-over-month decline due to equity and crypto trading. We should point out, yes, listen, the stock's taking a hit today, but you pull back the chart. This one's still up 230% this year.
Yeah, 230% on the year, 227% compared to this time last year. So quite a run-up that this company has had. And if you take a look, though, today, what is weighing on investors? Perhaps we're seeing some profit taking here, and that's because they got this report out saying that in the month of November compared to October, they had trading volumes that were down about 37% month over month. Option contracts traded were down about 28% month over month. Also, crypto, something we've been covering a lot, it did not have a good past few months. And so crypto trading volumes were down about 12%. But worth noting here, something that did do well for them was that prediction market model that they just got in. Event contracts trading were up about 20% from October to November. And so prediction markets seem like the next big wave wave here.
Yeah, impressively, even after this move, analysts are still overwhelmingly bullish.
Yeah.
Nearly 80% still telling clients this one's a buy here. All right, finally switching gears to Rivian, the EV maker revealing its own AI chip. So developing its own AI chip, Brooke, replaces NVIDIA per reports, will equip its R2 vehicle with this processor. TSMC will make the chip. CEO telling reporters we improved performance dramatically and simultaneously lowered costs by hundreds of dollars per vehicle.
Yeah, and yet you still see the share price now. Perhaps that's part of the AI sell-off we're seeing today. Perhaps a little more about Morgan Stanley note that we got earlier this week. Morgan Stanley analysts did downgrade Rivian earlier this week to underweight from equal weight. They noted that Morgan Stanley is leaning more cautious into next year, saying the electric vehicle, quote unquote, winter will sustain through 2026. And they went on to say that perhaps, more moderately, more positive outlook on internal combustion engines, so just, typical cars as opposed to EV vehicles. But definitely we're seeing this pullback. Rivian, though, has had quite an interesting, time trying to tread this market lately. Of course, they had partnered with Mobileye last year. They then had shifted that strategy to in-house. And so really Rivian trying to get ahead of this market. But you take a look year to date, the stock's still up about 25%.
All right, thank you, Brooke. Appreciate it. Meanwhile, Oracle shares getting pummeled as AI costs jump. And at one point today, with the declines in that stock, Larry Ellison's net worth plunged by more than $30 billion. D.A. Davidson's Gil Luria weighing in on the tech giant's results earlier on Market Catalyst.
Let's go deeper into the Oracle story with Gil Luria, D.A. Davidson, head of technology research. Gil, it's great to see you have been raising these flags. I mean, you're not alone, of course. There's a lot of concern in the market about Oracle. But I know you talked about what Oracle needed to achieve in this earnings report and on the call, and it looks like it didn't necessarily do that. So, I mean, what was the big sort of disappointment for you?
Well, first of all, they missed. That's never good. They set expectations, they didn't meet them. They set lower expectations for the next period. That's never good. But more importantly, they have this tightrope they need to balance right now, which is they have this huge commitment from OpenAI that they need to build capacity for, that they need to borrow money for. But what's become clear to everybody else over the last 3 months is that OpenAI can't possibly live up to the commitments that it's made to Oracle. At the time, OpenAI had only committed the $300 billion Oracle, which looked like a lot, but it looked doable. Since then, OpenAI has committed another $1.1 trillion to everybody else, which means that none of this is tenable. So Oracle has to still report over $500 billion of remaining performance obligations of backlog, when in fact everybody knows that $300 billion of that is phantom, because there's no way OpenAI can live up to that. While at the same time, Oracle needs to build out this capacity because they have a contract with OpenAI that says that they will. They don't have the capital to do it, so they have to borrow capital. They're still borrowing at investment grade, but they're very close to the threshold where they won't be able to do that. So they have to balance all these things. And the hope was that on the earnings call yesterday, they would be able to tell us how they're going to do it. And they did not have answers. They gave us some partial answers and ideas of how they could possibly do it, but they didn't clarify really how they can balance all these things at the same time, and that's why there's so much disappointment today.
Gil, the folks who are still bullish on this stock, pointed to that RPO number, and they said, that revenue is coming, or even if it's not the entire amount of that revenue, it's substantially more than their existing RPO, right? So why are you so confident that that is a phantom, that is a mirage?
Well, I think it stands to logic that OpenAI will not have $1.4 trillion to spend over the next 5 years, or that outcome is highly, highly unlikely. And if they don't have $1.4 trillion to spend, where in the line for the spending they do have does Oracle stand? We would argue that they're not front of the line. Microsoft is front of the line. Microsoft, who owns the biggest part of OpenAI, is front of the line. They'll get paid first. If there's something left over, I'd argue that Amazon is probably next. Maybe after that is Oracle, which is to say the $300 billion isn't going to materialize. Maybe a portion of it will. If OpenAI is able to raise $100 billion by the end of the year, they'll probably fuel their fire for another year or two. But if Oracle doesn't have $523 billion, they should just live up to that and say, hey, look, we've reassessed the contracts. And now that it's become clear that this isn't a contract that we are 100% guaranteed to get, we're going to adjust down that remaining performance obligation number to a more realistic point. I understand that that's tricky, but until they do that, they're reporting a number that everybody knows isn't real.
Gil, aside from that, kind of what choice does Oracle have? You know, as you say, you're suggesting they should reset expectations, which would presumably cause an even bigger re-rating in the stock, which is the trickiness you allude to. But at the same time, you know, when you look at their spending plans, for example, when you look at them chasing this market, it feels like they don't necessarily have an alternative because of the competitive landscape right now. Or do you say, well, they don't really need to be in this market as aggressively as they are?
Yeah, I mean, I think the way out they had yesterday, it's a very narrow way, but I actually think the way out yesterday would have been to say, we're not going to raise any more capital. We have capital, we're going to deploy it. As the customer continues to pay for it, that capacity, then we'll reassess to decide if we can borrow more and deploy more capital. That would have probably been the way out of this. Which isn't to say Oracle is in distress. There's a lot of conversation about CDS. Oracle isn't in distress. They have a core business that's very profitable. They can pay for the loans they've made. And by the way, if they build out capacity and OpenAI doesn't materialize, they'll be able to sell that capacity. This isn't a matter of distress. It's a matter of setting unreasonable expectations that everybody knows are unreasonable and sticking with them.
And sort of reflected that, you have a neutral rating on this stock. You do not have an underweight rating on this stock.
Yeah, because again, there is a viable business underneath all this story. There's a database business that's very high margin. It's declining, but it's very high margin. And then there's an OCI business, an Oracle Cloud business that is a good business that has tenant customers like Zoom Communications and ByteDance and is going to have a bigger role when TikTok USA is formed. That's a good business. And by the way, some of the AI Oracle Cloud business is an okay business. That's renting capacity to real customers like Meta and X that are creditworthy. So there is a good underlying business here. They just really need to manage this risk around OpenAI in a better way, which is to say, just reduce the expectations that this will materialize, or at least carve off a first year and say, first year we know we'll deliver this capacity, we know that they'll pay for it, and then we'll reassess.
Gil, while I have you, and while we're on the cusp of 2026, I'm curious to ask you what you're going to be most closely watching next year, not just when it comes to Oracle, but when it comes to your whole coverage and comes to the AI trade. Like, what are the big things that sort of need to happen next year for all of this to keep working?
Really, it's the core is the technology. Are the models going to get even better? Are people going to use them even more? Are companies going to start integrating AI into their business in a way that adds value and isn't just a proof of concept? If the technology works, the demand will follow and the build out will continue. And especially for those large companies that are the healthy participants here, Microsoft, Amazon, Google, NVIDIA, they'll continue to do well. We worry less about marginal players like Oracle and CoreWeave and AMD and companies like that are participating in the edges of AI. At the core of AI is TSMC builds NVIDIA chips that sell to Microsoft, Amazon, and Google, so we can do the things that we do with AI. And as long as what we can do, it gets better and better with AI, those companies will continue to drive significant growth. So we're just focused on the technology and the very large responsible companies that are deploying it.
The broadening of the rally today, putting the focus on the Dow Industrials. Jared Blickery has a deeper dive into Dow theory in today's edition of Stocks in Translation.
What if I told you one of the best ways to judge today's bull market was invented before the Fed, before ETFs, and even before the S&P 500? Charles Dow, co-founder of the Wall Street Journal and the name behind the Dow Jones averages, laid out a simple idea more than a century ago called Dow theory. And on today's Stocks in Translation, we're going to use it to show why this market still looks strong and how you can spot the cracks when they eventually show up. So Dow theory is basically this. It is a way of using the Dow Industrials and the Dow Transports to confirm whether the market's main trend is bullish or bearish, up or down. And here are some of the basic points. It was born from Charles Dow's editorials in the Wall Street Journal over a century ago. He never wrote a formal rule book, but later analysts pieced together about 250 of his columns and turned them into what we now call Dow theory. His big insight was to compare the averages of the companies that make the stuff, the industrials, with the companies that ship the stuff, the transports. When they're both going in the same direction, that is confirmation. And when one starts to diverge, that's a warning that a bigger change might be underway. And he was judging the market's big tides, not every little wave. He talked about primary trends that lasted years, secondary pullbacks that lasted months, and short-term noise that we mostly ignore. But regardless of the time frame, we use a very simple definition of trend: higher highs and higher lows for uptrends, and lower highs and lower lows for downtrends. And finally, Charles Dow would also look for volume confirmation in the averages. But because of the rise of electronic trading, ETFs, and other factors this century, we tend to see higher volume these days when indexes sell off. So it's probably best to ignore volume at the index level. With that in mind, let's look at some charts. And here I'm going to start out with a 5-year look of the Dow Industrials, that's in purple, and the Dow Transports, which is in light blue here. And what you notice is that the Dow Industrials are up quite a bit more, up about 62% versus 39 or 40% for the Dow Transports. You also might notice that the Dow Transports are just testing their record high from late 2024, about 1 year ago. But here's what I want you to notice. While the Dow Industrials largely were in an uptrend from the third quarter of 2022, during that same time frame, the Dow Transports were stuck in this sideways range. And they actually started to break out of it in late 2024. That's this little oops that we're looking at right there. But then they sunk back below. And I'm going to zoom in on this time frame with a 2-year chart, and I'm going to show you how this was a great warning sign. So here in purple, we still have the Dow, and so it made a record high here, came back, pulled back, and then it was testing its record high. When that happened, the Dow Transports could only get about halfway back up. Then they proceeded to sell off, test that little high again, and then they broke this low right here. And in fact, the Dow Transports and the Dow Industrials were both breaking their lows at about the same time. But you really had a pretty good warning in late January, early February that something was amiss in the markets and that we might have a downturn. Were we predicting that tremendous post-Liberation Day sell-off? Absolutely not, but we were expecting perhaps some kind of market decline. Finally, I want to show you what things have looked like since that April 8 bottom. That's when things really turned up. That was 171 trading days ago. And here you can see the transports have actually pulled ahead. They're up almost 40% here, and they really only broke out of this long trading range very recently. And so with this very long base, it reminds me of the slogan in technical analysis: the longer the base, the higher in space. And that's exactly what we're seeing right here. So both the Dow Industrials and the transports are making new 52-week highs right now. And that brings me to my summary conclusions here. How exactly do you use Dow theory yourself going forward? Now, since both indexes are currently in uptrends and making new 52-week or 1-year highs, we're only going to cover the bull case here, but the bear instructions are simply reversed. So first, are both averages in an uptrend, making higher highs and higher lows? Or is one starting to flatten out like we saw a year ago? Then when one flattens out, you might actually see it break its major low. This is a kind of change that leads to a bearish trend change. So that divergence can be an early warning sign like late 2024. And do both keep making new 52-week highs, or is one only pushing higher while the other tends to chop sideways? And finally, can you look at the breadth of participation inside those indexes? Are a lot of transport names and industrial names participating in the move, or is it just a handful of stocks pulling the averages higher? Price action always rules the day as only price pays, but low participation can be an early warning indicator of a potential trend change. So putting it all together, things are looking bullish as we wrap up a year full of surprises. And when the story changes, Dow theory won't call the exact top, but it will tell you when the big tide has started to turn. And tune into the Stocks in Translations podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
Coming up, a deeper dive into another tech giant's results, Adobe, how the company is navigating the rise of AI. It's coming up next. Adobe is seeing rapid adoption of its AI-driven tools as fourth quarter earnings top estimates. Software company is getting further into AI with the launch of Photoshop, Adobe Express, and Acrobat for ChatGPT. And we have just the person to dive deeper into all of this. Let's welcome in now Anil Chakravarthy, president of Adobe's digital experience business. Anil, it is great to see you. Let's get right into this report, Anil. So, record revenue and cash flows. It looks like upbeat annual forecast relative to expectations. Walk us through the quarter, Anil. What are you seeing in the business?
Well, thank you for having me on. I mean, yeah, we exactly as you reported, we had, as you said, we had reported record results. We also had a forecast going into next year of, would set up a target of greater than 10% growth in our annual recurring revenue for total Adobe. So what we're seeing in the business is customers really want to use our software powered by AI. So they want them together. There are already a lot of customers who use our apps. They like using our apps, and us bringing AI, not only our models with like Firefly, but a variety of third-party partner models in the context of the work that they already do. There's a lot of demand for that, and that's what gives us the confidence for the target we set out for next year.
Anil, one metric I know the street is focused on was the margin guide. The initial guide here for 2026, it does look like that's a downtick from 2025. What are the puts and takes there, Anil? Can you just walk us through that?
Yeah, if you look at the margin is a very healthy 45%. I think it is, as we go into the year, one of the things that we're doing is we're continuing to invest in our innovation. I think at Max, a couple of weeks ago, we showed a lot of innovation on how to bring AI into our software across the breadth of our portfolio, and also introduced a number of new apps that were powered by AI. We're continuing to do that as we go into 2026, investing in our apps, investing in third-party models, investing in inference capabilities, making sure that we are allowing ourselves enough room to invest for growth and to make sure that our customers have the latest innovations available and AI available. And the margin guide that we put out there reflects that room for innovation that we have.
Anil, it does look like, I'm just looking at the segments here, it looks like digital experiences growing slower than digital media. Why is that, Anil? And what's the kind of the plan to accelerate that business?
Yeah, how we look at the digital experience business is in the context of the customer groups and the audiences that we serve. We serve business professionals and consumers, we serve creators and creative professionals, and we serve marketing professionals, which is where the business comes in, the digital experience business comes in. And actually, we are the largest provider in that category. And, compared to some of our peers, we're actually growing 10 points faster than the closest large peer that we have there. So one of the things we see is that ability to bring together different aspects of our portfolio. Being able to bring all our creative and our marketing capabilities together helps us serve the top of mind needs that the chief marketing officers have, whether it's in being able to produce the right content very cost effectively in a very agile manner for any channel, or to be able to take their own brands and make sure their brands are visible in new channels as well as the channels that they own. So channels like new LLMs and the new agentic web, in addition to their own properties like their websites and their mobile apps. We're uniquely capable of bringing that together, and that's what you see in our results for the digital experience business.
Anil, just to dig into this a bit more, the stock is up today, Anil, but it's down about 20% this year. And I think, Anil, there are just plenty of investors who are concerned, Anil, and maybe even skeptical. They think, what? Adobe might not be an AI winner. It may turn out that you are going to be disrupted by AI ultimately. And I guess the key question I'm driving at, Anil, is, what is Adobe's real value add here in this era of AI, in an era when we know just a lot more folks, Anil, are increasingly going to use these free Gen AI models to create content?
Yeah, the way we think of where the market is, software is going through a major transformation from software as a service to agentic software powered by AI. As you know, Adobe went through a similar transformation several years ago where we led it going from on-prem software to software as a service, and we obviously navigated that transformation extremely successfully. We believe that we're going to do the same thing now with agentic software. When you think of what customers actually need, they want the apps that they are very familiar with, that they're getting a lot of value from. They want those apps to become better with AI, like Photoshop integrated with ChatGPT, for example, that we announced yesterday, being able to bring those kinds of AI capabilities right into the tools and the software apps that they are so familiar with and that they get so much value from. That is, I believe, the unique advantage that Adobe has. And so as we think of how this plays out, I mean, look, since even all of this AI was announced just over the last year, we just reported record results, and we grew our annual recurring revenue over 11%. We're guiding to over 10% growth for next year. So we believe that from a customer perspective, the answer is already very clear. They want both. They want both software and AI together in the same context of where they're actually using these apps. And ultimately, the market will come to see that value as well.
It's interesting, Neil, because I had this chat today with an analyst who covers you all this morning, and we were talking about the results. I want to get his take because he's a smart guy, thoughtful guy. And by the way, he's a fan of Adobe. He tells his clients Adobe is a buy. He said that. And it was interesting though, Anil, because he said, I look at Adobe and I've got a buy on the stock, and I look at this performance. He says the performance is solid. They have a good story to tell. They're giving their customers these tools that help them edit and share and publish images and do it in a way that they're not violating IP rights. He said the issue though is almost like there's just this perception problem with Adobe right now. It's a story problem. It's a narrative problem. It's just like a lot of people just have this story in their heads of AI winners and losers. And right now, they've got a narrative about Adobe that it's not going to be an AI winner. I'm just curious what you make of that. If the issue is a perception issue, how do you navigate that?
Yeah, I think, look, I think that's a simplistic narrative. And one of the things that we are doing is, we're putting up numbers that show that consistently over a track record, we have a clear strategy of a clear vision of where we believe this agentic software will go. And, through consistent execution is where, I believe that perception will change, because all of the folks that you talk to, they're obviously going to track us and hold us to our results in which we are delivering. But they'll also talk to customers. And as they talk to customers, they come to realize that, customers want both. They want the software and they want it powered by AI. And it's not an either or there. And as that becomes more clear across the market, the perception will take care of itself.
Anil, great to have you on the show today. Thanks so much for your time.
Thank you for having me, Josh.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.